Just interrupting on it.
Sure. Hey, good morning, everyone, and welcome. So I wanted to start out with a market outlook in terms of both the economy and markets in terms of where we're positioned. And I really wanted to go through a couple of different scenarios, lots of forecasts, lots of information. So happy to make this interactive session. You have any questions or comments along the way, just please feel free to dive in. So effectively, we're kind of looking at three broad scenarios for the economy. One is the soft landing scenario, which seems to be at the moment the majority perspective in terms of slowing down the economy and kind of maybe flat growth to sideways growth. I'll call one scenario the no landing, which is we just keep growing. Maybe we have a little more inflation with that. And then, of course, the recession or the harder landing scenario where the Fed causes a recession. So I think on balance, it's about 50 to 60% chance we have a soft landing. I'll go through that in terms of what we're seeing on the research side. Maybe 20% for no landing and about 20% for a hard landing. So we'll kind of work with those scenarios and go through the economy and go through the markets in terms of what we're seeing. So basically, the batting average for the Federal Reserve is about 40%. So they have been successful 2 out of the last 5 times in terms of trying to have a soft landing. So they were successful in the very early 80s, and they were successful in the mid 90s. So that's the 2 where they got it right. And in the late 80s, they got it wrong. In the late 90s, it did not work. Obviously, 2007, 2008, it did not work. And 19 is, I think we'll call it a draw. That was the COVID doesn't really hard to factor that one in. Is it going to work?
I have your
Is there? Okay. Can this work?
Are you seeing it on the screen?
I can see on the screen.
Don't use that one, but it is. Just tell me when it
Okay. So I think page 2, just the scenarios, the overall cycle.
Yeah. I'm just waiting for it to come up. It's
Okay.
walking.
So effectively, the Fed has been able to navigate soft landings. So the question really is this time, do they have enough scope to have a soft landing? So just in terms of a couple of things we look at, a lot of people have themes in terms of what we might see for this year. In terms of themes, I thought we'd actually look at it from a structural perspective. So I think it's the second page, Marty, on the structure. The one key part of the dynamic that's different this time, especially compared to prior cycles, is that the size of financial markets is dramatically larger. So we have these very distinct feedback loops between capital markets, specifically the debt market, and equity markets and the real economy.
It's on the screen.
On the screen.
Up here. Just keep on.
Sure. All right. So the back in 2010, Bernanke had actually wrote an op-ed in the Washington Post and basically said that financial conditions work as a virtuous circle and provide a positive feedback loop to the economy. If you have lower rates, you have higher mortgage activity. You have higher mortgage activity, you have higher residential activity. If you have lower rates, you have higher consumer spending. If you have consumer spending, you have more profit for companies. You have more profit for companies. You have more reinvestment, and you get a virtuous, what he called a virtuous cycle. So that virtuous cycle works. And the last 15 years we've had rates were effectively mispriced. We had interest rates below the rate of inflation. So they were negative rates. So now we're about to go into the reverse of the virtuous circle, which is that we have higher rates, which in theory should have lower consumer spending, less mortgage activity, less real estate activity, and less investments. So the issue is that showing up now? No?
Yeah, he's going to make
Okay.
You should be able to see it.
I can see it here, sure. So basically, just put the numbers in context for you. The economy is about $28 billion. So $28 billion is the economy. Financial capital equity markets are about 49. I'm sorry, I said billion, trillion. So $28 trillion is the economy. The capital markets in the US are about 49 trillion, and the debt is 57 trillion. So those markets, when they have issues, they feed back into the economy pretty quickly. And we just saw that. Last in November. The long-term rate went up to 5%, and the market was concerned that there would be funding issues with the government treasury and the government debt. And what the government came forward and said was they're going to change the duration of the maturity of their structure for when they go to market to borrow. So they basically said they're going to do less long-term borrowing and more short-term borrowing. And that took the 10-year from 5% back to 4% in about 3 weeks. So if you go back to November to December, if you look at the market outlook research that was published by a lot of the big shops, if they wrote it in November, they said one thing about the 10-year bond. If it was written in December, they almost said something else because the bond moved by 100 basis points, which is a pretty substantive move in a month. So the 10-year at 5% is very different than the 10-year at 4%. And today I think we're right at about 4%. So that communication between the policymakers and the market is pretty active. And I think any forecast going forward today is very sensitive to what the Federal Reserve does and to how that plays out. Thanks, Marty. So I think the next page, this is just the cycle. Yeah, so this is just the context in terms of the cycle. So we put maybe 56% chance for a soft landing, 20% chance for no landing, and then 20% chance for a hard landing. And I think it's very, very much policy dependent. And that's really in the hands of the Federal Reserve. So we have more active Federal Reserve. We have a larger balance sheet. The balance sheet, I think, on the prior page just shows that it's about 38% of the Federal Reserve balance sheet is about 38% of the size of the economy. So that's the construct. If we just go forward a couple of pages to the GDP numbers, the forecast for the U.S. for GDP is about 2%, 1.5%, 1.5% for the U.S. economy for this year. And effectively, if we look at the global outlook, we're looking at overall, I'm ready for the page 6. All right. So that's the U.S. So what's remarkable in the U.S. economic growth is for everything we've just gone through with the COVID and the inflation and return to work, we're right back at 2% growth, which is the average over the last 2 years. So in the prior 10 years, if that was normal, quote unquote normal, from post financial crisis to 2019, we averaged about 2%. We went through COVID, start, we're back to 2%, which is quite remarkable given everything that we've gone through. So we're looking basically at being back to somewhat of a normal footing. The difference, of course, is that the last 10 years had very negative cash rates to real rates. And of course, say we have rates of 4 or 5%. So then just flipping ahead to the global economy, if we look at the growth on the top right-hand corner, that graph just shows the forecast. I know it's a little bit difficult to read, but effectively the global economy is about 2.9% expected growth for this year, which is a little bit lower than historical average. The main graph on the left-hand side, the point I just want to make with this chart is that the US and China are almost 40% of the contribution of global growth. So from your perspective, when you pick up a newspaper, you can ignore almost everything except for 3 countries: India, China, and the US. So India is growing at probably the fastest rate. They're about an 8% contributor to global growth. China is growing at about 4 or 5%. They're a 25% contributor, and the US is about 14%. China and the US were much higher if you go back 10 or 15 years ago. So even the Chinese-US component is less important today than it was 10 years ago. But from our perspective as investors, every other country is literally about a 1 or a 2% contribution, from Germany to the UK to Japan. So it's obviously very broadly based from a global economic perspective. So that's why a lot of the issues that we hear about, they sound dramatic, but they're not always as dramatic because most of the country's contribution is fairly low. So that's where we're looking globally. All right, so from
that bottom chart is what?
The bottom chart is the contribution to growth. So that's the, on the left-hand side, the tall bar, that shows the Chinese is about 25% and the US is 14%. Then India is 8% and everybody else is basically 1%. So choose your section of the newspaper wisely. You can just ignore most of the countries unless you're going to be there. So then just moving ahead to the inflation. All right, so inflation. I believe that the latest reading is going to come out tomorrow. So just to keep this very simple, the Fed effectively on a monthly basis has to be between 0.1 to 0.2%. And if you look at the history going back to 2010 to 2019, when they were successful, they had a batting average of about 70%. So that means that 7 out of 10 months, we were in target for the inflation range, which is 2%. So that works back to a monthly rate of 0.1 to 0.2, basically, in that perspective. So where we are today is the Fed has missed for the last 4 months, but the prior 2 months, which are back to June and July, we were on target. So June and July of last summer were the first time in 2 years we were actually in the target range. We were just slightly above the last 4 months. So I would argue that we need to see at least another 3 or 4 months in target for the Fed to start talking about cutting rates. So you can look at the 3-month average, you can look at the 6-month average. A lot of people look at the sticky number. Some people look at real estate. You can look at a lot of different components. It doesn't matter. They have to get back to their target range and at least have 3 to 4 to 5 months in that range to argue that they are making progress. So I think that's a simple indicator when you're looking, we're looking for 0.1 to 0.2, 0.22, 0.23, 0.24 in that range is fairly good. So tomorrow we'll get our first mark. If we're a little bit hot, then they're not going to have any months really. They're going to be 2 out of the last 7, which is not close to 70%. So I'd say they have to get to that 70% range at least. That would mean at least the next 3 or 4 months would be on target to get to Q1, Q2, where they can talk about cutting rates. And now, so it's a race. So we go to the next slide. It's a race between the Fed inflation coming down and the stress we're seeing in the system now across bankruptcies. So if we look at defaults on loans and high yield bonds, they've started to rise. We look at investment grade defaults, they've started to rise. We look at Chapter 11 commercial bankruptcy filings, those are rising. Auto loan defaults are rising. Delinquencies are rising. Credit card rates are now 22% and auto loans are around 8%. So obviously, these are all very high numbers vis-a-vis historical numbers. We're not at recessionary levels, but we're at the bottom end of what looks like it could be a recessionary period. So effectively, you either need to see some give in some of the defaults and some of the bankruptcies, or that's going to move the economy closer to a recession. So, or the Fed has to take their foot off of the gas pedal in terms of where they are. And then just moving to unemployment, the big difference in this cycle with prior cycles, just on the next slide, Marty, is that the absolute number, we're seeing about 200,000 claims weekly, unemployment claims, but that doesn't really get adjusted for the increase in the size of the US labor force. So to put those numbers in context, today the workforce is almost 160 million individuals. If you go back to the 1990s, it was about 110. So to get a slowdown in the economy, roughly you need about 0.5 to 0.6 to 0.7% of the workforce to come out to lose jobs. And GDP, just by definition, is the number of people working times the number of units output, and that's all it is. So if we lose 1% of the workforce, then that would reduce GDP by 1%, all things being equal, assuming no change in productivity. So you really need to see numbers around 600,000 that are comparable to prior cycles that caused us to get towards a recession. So right now we're at 200, so we're not close, but if you're looking for a simple benchmark, you're looking for that 4, 5, 600,000 number weekly to see the economy actually slowing down. So we don't have to, we could, again, if we go sideways, you might see the number go to 300 or 400,000, and you might see fewer jobs created, and that would be more of a slowdown from the Fed's perspective. So that's the interplay. It's basically the stress in the system the Fed is causing on purpose to slow the economy down between defaults, higher rates, and potentially a start in seeing more claimants on the unemployment side. So just moving to rates, the market today, the question really is where's neutral? So right now, the Federal Reserve is priced for a hard landing, which means that if you look at the inflation rate, which is about 4%, the federal funds rate is 5 to 5.25. It's about 125 basis points real. So that's pretty high by historic standards. The last 15 years, we were negative 50 to 100 basis points. That was extremely loose policy. So the market right now is pricing in about 4 to 5 cuts. That's going to get us to 3.8 or 5. Let's call it 4%. That's 5 cuts to 4%. That's fairly aggressive. Again, I think it's going to depend specifically on the next 3 or 4 months on inflation and how unemployment claims look. So the market's priced for a hard landing. The Fed is in position right now for a hard landing. They have to take their foot off the brake at just the right time to get us back to a soft landing. If we go look at inflation break-evens next, what we see is that the market believes the Fed will achieve their goal. Break-evens are right at 2.2 to 2.3%. That's 5 in the 10-year. So the long-term expectation is that the Fed will reach their target, which gives the Fed breathing room to navigate through and a little bit of time to do what they feel they need to do to get the inflation rate down. And it was at 2.5 just a few months ago. So if the number's at 2.5, the Fed has less room because they don't want to lose they want to use the target on long-term expectations. So for now, they're on target. The market believes that they can hit their expectation. And as long as those numbers stay stable, that gives the Fed a little bit of leeway in terms of what they're doing. Going forward to financial conditions, the issue is that financial conditions are not very tight. So with the 10-year falling from 5 back to 4 just in the last month, we've actually loosened financial conditions on the next slide. So the challenge is that the Fed is trying to tighten financial conditions, and they're not really, we've come back down. So then if you look at the last few months, we tightened conditions, and then we came back down to looser conditions because the 10-year went from 5 back to 4, and capital markets have still been quite strong. Equities are quite strong. So that feedback loop between the 10-year, the rate on the 10-year, and the value of stocks and wealth still puts a lot of juice in the economy, if you will. So arguably, if conditions stay looser, they might stay higher for longer to try and get financial conditions to come back and be a little bit tighter. And if you look where they were successful in the very early 80s and the mid 90s, they were still below the average of zero. They were still loose, but they did distinctly tighten conditions. So they'd likely have to get things a little tighter from where we are today. I'm not sure 4% on the 10-year is the ideal place to be. So that's rates. So the Fed priced for a hard landing, looking to reduce and move us to a soft landing if they're successful. Moving forward to credit, this is the investment grade bonds. This is the spread. So this is the difference between the yield on corporate bonds and the 10-year treasury. And these are very low by historic standards. So bonds are priced very, very tightly. And what that means is they're effectively priced for no landing, which means that they don't see a slowdown coming. They're not worried. They're not worried about the credit risk. There's very little credit risk priced in the investment grade bonds today. That's maybe fair because the top corporations have very, very strong balance sheets. So the largest firms in the S&P have very good balance sheets. There's little concern that they're going to default. Nonetheless, it's very tightly priced. So if we do see some stress in bond markets, investment grade is somewhat exposed, but it's effectively priced for no landing. And then if we go to high yield bonds, which is the lower next rung down, lower for corporate bonds, they're also the spreads are very tight. So we're 2.5% to 3% above the 10-year, which means we're about 7%. So those companies are borrowing at around 7%. And those spreads are quite tight by historical standards. They're not quite as tight as we were in the early 06, 07 period, which was definitely a bubble from a credit perspective. So these are also priced effectively for no landing. Keep in mind, this segment is more sensitive to a soft landing. So investment grade probably is not because they've got very good balance sheets, but high yield is not as strong in a harder landing scenario. So these are also priced quite tightly. And then if we just look at private credit in terms of returns, private credit is a very broad area. So we can look at direct lending or leveraged loans or distressed debt. This is an interesting area. I would just caution that you're typically, middle market is really small cap to micro cap names. So you're lending to small and micro cap names, which in theory are the first to get exposed to higher rates into a slower economy. So I think the credit risk is much higher if the Fed stays higher for longer. Then there is concern that this area could potentially have some impact initially. Now it is.
Can you just jump into private credit return lower because people were locked into lower rates as a result for the duration?
It's a good question. So most of the numbers that I have seen on private credit are in that 7, 8, 9% area. So on this particular area, the direct lending is a little bit higher. It's just below. It's about 8% for that segment. The other ones are a little bit lower in part because there wasn't as much distressed debt, and some of the private capital lending was done at different rates. So there's pretty broad dispersion in these indices. That's the other challenge is there's a tremendous amount of dispersion on the private market side. I think at this point in time, mezzanine and distressed anyways would be an interesting setup going into this year if we're looking for some distress. And I would mention the key point is there is a tremendous amount of dry powder. So for all the private markets, private credit and venture and private equity, there's a tremendous amount of cash on the sidelines, which is one of the reasons that we were thinking that the soft landing scenario is a little more prevalent because anytime you see any market stress, there's a lot of cash waiting to come back in to play. So I do expect these returns to be a little bit higher this year, given that the base rate is that much higher.
Where does the cash number come from?
The cash.
Is cash on the sidelines?
So the cash, so dry powder. So the funds on the private credit side have about $600 billion of dry powder from the funds. Venture capital also has about $600 billion of dry powder, and private equity is over $1 trillion. So there's a tremendous amount of money that will step in as soon as there's some distress or any kind of movement in some of those markets. So I think we get very much of a sideways year, like with the 10-year that we just had in November, December. That's a big move of 100 basis points. I think you see some of that in private markets, maybe not as quickly, but you certainly have the potential for that. So that's credit. Then we'll move to equity. So from the equity perspective, the equity market is expecting growth this year of 11% on earnings. That's a pretty aggressive number.
10 minutes.
10 minutes? Okay, so that's where the equity markets are. So that's a fairly aggressive number. Again, this is priced for no landing. Now, this is difficult given that rates are 5 or 6%. We've got some rise in defaults and bankruptcies. There's probably pressure here. But that's how we're priced. Now, I just want to go through equities, and I want to kind of put this in context. So what we had in 21 and 20 was a huge year for IPOs. And if we just go to the next slide, Marty, on the growth versus value. If you look at the growth versus value in 20 and 21, we had a pretty significant gain for growth stocks over value. That's that 20 to 21 period that you can see on the chart. Growth has really won since 2017. It lost in 22, but then the comeback in 23 was almost the same as what was given back in 22. So the big question is, will growth dominate going forward? It's a big discussion, but what this was driven by in part was aggressive growth stocks. If you just go to the next page, Marty. So we had, and I use ARC as a proxy for aggressive growth. ARC stocks were trading about 12 times price to sales at the peak in 21. And the value growth slide, which is the blue graph, looks kind of like the ARC performance. So when the growth stocks traded off in 21, 22, ARC traded off significantly as well. But the multiple was extremely high. Growth was about 33 times earnings at that time in 21. ARC was 12 times sales. Before that, ARC was about 4 times sales. The price came back 70, 80% for the ARC fund. It is now back to about 4 times sales. And growth today is about 26 times PE. So again, that's expensive relative to where cash in the 10-year is. So the concern is that markets are still quite richly priced, expecting 12% growth, and rates are higher. It's a difficult situation to navigate through for some of the stocks. I just want to put on venture capital on the next slide. We overlaid the returns from venture capital on top of ARC. So we use this maybe as a dirty proxy or kind of a rough proxy for what venture capital returns look like vis-a-vis ARC, because they're similar companies in terms of the aggressive growth nature and some of the lower earnings. But the gray line is the same as the gray line in the prior graph. So ARC went up and came back down. Venture capital returns were very similar. And they have now corrected, but they have not corrected anywhere near as deeply as the public markets have. So we're probably still looking at some down rounds in venture capital in 24. Again, very tremendous amount of dispersion in terms of the sector by sector, but the multiples were quite high from the IPO. If you go to the next slide, you can just see the IPO numbers. So we had a huge IPO, huge IPO in 20 and 21 that filtered through into the ARC returns or the public markets. And you had a lot of companies that went private at that time. If you go back, you had you had Spot and Snap and Datadog and Airbnb and Snow and CrowdStrike and a lot of the cybersecurity firms that had tremendous moves in that time period. So that combination of a lot of firms coming to market with IPO led, you got higher valuations, you had great returns in venture capital, and you had great returns in growth. So it's unlikely we will repeat all of that going forward, given where rates are today. And the multiples still have to re-rate. So I think the venture capital, there's probably some down rounds there. Potentially some of the firms that have a longer track record or longer trail back to profitability, you might see some closures in that area as well. Then just going to private equity. Fundraising for private equity, all the private markets look similar to this. They had the very strong year in 21, 22 tailed off, and 23 was lower. Private equity looks a little better than private credit and venture capital, but that's effectively how some of the numbers have looked. The exit values or the exit activity has come down significantly. And what's interesting is the exit to investment ratio is actually quite low. It's down to about 50%. So the private equity firms are holding their positions much longer. And arguably, if you hold those positions longer, or they have more they want to try and bring to market, there's more of a traffic jam for some of these exit scenarios to follow through. So as the markets re-rate, and just on the next slide, Marty, just the valuations for private equity have actually been fairly stable. But as the markets re-rate, arguably we'll have a little more congestion as some of these entities either try to come to market for an IPO, or if you might see more buyout activity. You might see a lot more activity in the secondary. Secondaries are probably an interesting positioning in terms of opportunity to buy some from some of the funds that have some of the price on the mark on the price to now. So the valuations for private, again, there's tremendous dispersion across this, but they've been fairly stable. But they're both high relative to their historic levels. That's the S&P. This is using enterprise value now to EBITDA. So they're high relative to their historical levels, and again, they're both high relative to cash and to the risk-free rate, to both bonds and cash. So then just moving forward to private infrastructure on page 28. So the cap rates for real estate, same thing here. If you look at the public markets, which is the pink line, you REITs did come off quite a bit last year. So they did re-rate higher from a multiple. The cap rate's around 6, which again, if the 10 years of 4 or 4.5, that's not that much of a spread. So it's better than what it was certainly before, but it's not that large of a spread relative to the risk-free rate. The private markets have not re-rated as far. And certainly if you look at commercial real estate, there's a tremendous amount of stress in the commercial real estate market, depending on the area. The occupancy rate is quite high. I think it's at 19 or 20%, which is around 15 or 20-year highs. And some of the lending now that's happening for some of the larger, or for some of the commercial real estate is happening at 8 or 9 or 10 or 11%, even for development. So arguably on the private commercial, on the private real estate side, there's a further re-rating to go in terms of pricing. So that likely has to flow through. And then just going forward to a couple pages to page 30, just to bring this all together into context, the issue really is the risk premium, like what's available is the risk premium. Marty, if you can flip forward 2 pages. So this is what the framework looks like today from a valuation perspective. So cash, let's call that, cash is at 5.25 to 5.5. Very rarely is it a good situation to have cash be giving you more than stocks are paying. So stocks are about 19 times earnings. So the earnings yield, which is just the inverse of the PE, so the earnings over the price is the inverse of the PE, which PE is about 19. So a 20 PE gets you about a 5% earnings yield. So we're just below 20, we're about 19. So it's a 5.1, 5.2 earnings yield. The 10-year bond's at 4. Historically, you want at least a 200 to 300 basis point spread between the 10-year bond and stocks to make the higher risk worthwhile.
We've got a couple of minutes.
All right, so just I'm going to finalize on this. So what we're really looking for is just how all this, what the spreads look like today. The difficulty is really just that the discount rate is that much higher and the risk-free rate is that much higher. So the markets have readjusted, re-rated the public markets certainly. Just caution the one difference is that the large cap names, because the index is skewed to these large cap names, the handful of names, the Googles and the Meta and the Microsoft and NVIDIA, they're actually not that expensive relative to their characteristics in terms of their profitability and their growth. So these firms have huge margins. NVIDIA has 45% margins. Microsoft has 45% margins. Meta and Google are 25 and 35%. So they're not, and NVIDIA is only 24 times PE. So they're actually not that badly mispriced. So the overall market still looks expensive, but that skew to those large names isn't that far off. Maybe Tesla is, but these are some pretty large firms with great balance sheets, and 2 of them have over $100 billion of cash. I think Microsoft and Google both have $140 billion of cash on their balance sheet. So, they're kind of in a subset on their own. The average stock is about 15, 16 multiple, which is probably about the right place to be. So the market overall looks a little expensive. I think the earnings number is a little bit high. And I think we get much more of a sideways year this year as we go through each of the 3 scenarios. What looks like a soft landing, which then might look like a hard landing. By definition, we have to look like a soft landing before we actually see a recession. and then we could have no landing. So I think we're going to get all three iterations as we go through the year, and there'll be lots of opportunity both publicly and privately in terms of positioning, and definitely an opportunistic or active year in terms of grabbing returns. And then just to close out, this is just showing a potential portfolio and where we'd invest some of the capital today. So it's 35% in public stocks and only 15% in bonds, in investment grade bonds. And the rest is made up of infrastructure, private equity, real estate, and some venture capital. Interesting, I'll just close on this. Infrastructure is probably a nice middle ground this year because rates on private infrastructure are about 8 or 9%. You're buying boring, stable firms with regulated cash flows that probably, if they get 8 or 9%, are pretty competitive, but equities and are very stable and are a good diversifier to public markets. So infrastructure, and they have a build-in for inflation. So infrastructure is probably an interesting place to be for some of the allocations. With that, I'll stop. And is there any questions or comments? Happy to take those.
And we're out of time.
Out of time? All right.
Thanks so much.